The second part of the talk, I will document the macro adjustment of the Chilean economy. This section, in turn, has two parts. In the first, I'm going to show how exchange rate flexibility has facilitated economic adjustment to macro shocks. And for that, we're going to use a natural laboratory provided by the last two important crises that Chile, as well as other countries, faced, namely the Asian crisis and the global financial crisis roughly 10 years after that one. We'll see that Chile performed significantly better, not only in absolute terms, but also compared to other emerging countries in the second episode. And we believe important part of this better behavior and adjustment is due to the fact that the exchange rate was free-floated. And finally, I'm going to document that in response to financial shocks that are well identified using event study methodology, indeed, the asset price volatility of Chilean asset markets is more rotates away from the volatility in bond and stock markets towards the exchange rate. And in this sense, the exchange rate seems to be playing an important role in cushioning external financial shocks. Right? So the paper, as I said, has two main parts. The first, we're going to document these two key elements of transition towards fearless floating, namely how firms' currency exposure evolved after free floating, and the evolution of the exchange rate pass-through throughout this period. And then in the second part, I'm going to document how these adjustments have served the country well by cushioning external shocks. Okay. So to speak about the first issue, the evolution of currency exposure in non-financial firms, we're going to use a data set that is an unbalanced panel of roughly 300 firms that are regulated by the CMF. Most of the data in this section comes from the CMF, although it's merged with other sources of data. This data is available quarterly since 2001 and yearly since 1987. Unfortunately, the data doesn't go before that. And what does it include? It includes asset and liabilities by currency. It includes income statements. Importantly, it includes derivative registry. This is the census of all derivatives transactions that we're going to merge with this other data. And also central data on customs registry. Let me try to explain this figure, which if I had to pick one figure from the paper, it would be this one, probably. What we're showing here is the whole distribution of firms' exposure to the exchange rate. So if a firm appears on the positive quadrant, then it means it has more US dollar denominated liabilities than assets. Okay, so a depreciation of the peso would hurt the firm. That's in the positive side of the figure, right? But the distribution also contains firms that have the opposite exposure. They have more US dollar denominated assets than liabilities. So they would stand to lose from a depreciation of the dollar and appreciation of the peso. And here we're plotting the complete distribution. So the, I guess, purple bars contain the 25th to 75th percentile of the most exposed firms, while the gray bars include the 10% up to the 10th 90% percentile. And what this figure shows is that exposure of firms, if you look at the median, maybe you'll miss a little bit of the message. If you look at the whole distribution, you can see that there were a decent number of firms which had quite a bit of exposure, up to 2%, almost 20% of the assets for the most exposed. And after the introduction of the exchange rate regime, this whole distribution starts compressing down toward almost zero right now. At most, say the most exposed firm in the 10th percentile would have roughly 5% of their assets as exposure today. The right-hand side figure repeats the exercise, but also includes the net derivative position. Okay? A message that arises here is that the derivative position plays a role, but it's not a large role. So basically, the bulk of the adjustment for most firms is actually taking place directly through matching of assets and liabilities, and I'm going to give more information about this in the next couple of slides. Here we separate this group between firms who are involved in international trade, that would be the right-hand side figure, and those who are mostly domestically oriented. You can refer to the paper for the definition of who is an exporter. It's actually not as trivial as one might think. What you see here is that essentially firms who do not involve international trade, they essentially don't have any more exposure. They stop having exposure. They started with a decent amount of exposure, and they have declined throughout the period. But firms who are involved in international trade do maintain some degree of exposure, and I guess that makes sense. This is probably a natural hedge to what's the core business risk from either exporting or importing. Now, I'm going to, in the next slide, what I'm going to try to document is how this reduction in exposure takes place. So take the firms who have who are exposed to the dollar in the sense that they have more liabilities, right? That's the firms who are in the positive quadrant of that figure. So I'm going to document how that decline came about, whether this was driven by adjusting your assets and liabilities directly, or whether it was driven by taking more FX derivatives. Okay, so essentially I'm going to describe this this compression of the exposure for the firms in the positive quadrant, and also the ones in the negative part of the figure. And this is what is shown in this picture. The left-hand side figure shows the evolution of the balance sheet for the firms who had more liabilities than assets denominated in foreign currency. And as you can see, well, maybe you cannot see, it's not an easy picture to explain. Let me just give you the main message. This figure shows that essentially the work was done by directly reducing liabilities. So recall that most firms in this sample are not involved in international trade. So you might think, what business do they have having liabilities in a foreign currency? That probably has something to do with the development of financial markets back in 1999. And this figure shows that after the introduction of the free floating exchange rate regime, this incentive to be mismatched goes down significantly, and firms essentially stop having debt in dollars to a large extent. Something similar occurs with firms who had excess assets in US dollars. They start reducing this exposure. That's the right-hand side of the picture. And that's mostly by reducing the amount of assets that they had in foreign currency. Now, this brings two questions to mind. First, do derivatives play some role in firms' management of currency risk? I'm going to show you that the answer is yes, although you cannot see this very clear from this figure. And second, who are the main players in the FX derivatives market then? For time considerations, I'm not going to go through the second question. Let me just give you the brief result. Main players in the FX derivatives market in Chile are pension funds, international investors, and banks, local banks, who are on the other side of pretty much every trade. So they're the intermediaries. Firms play some role, but it's a minor role. So essentially, firms seem to benefit from the liquidity created in this market by these other agents. So let me go into the issue of whether firms are involved in the use of derivatives. This figure shows, for this subsample of firms that I described, what share of these firms are actively involved in trading FX derivatives. And as you can see, this fraction is rather large, close to 60% for firms who are involved in international trade. You can also see that this fraction for different types of firms went up significantly after the introduction of the freely floating exchange rate regime. And to give more precise evidence on what drives the decision of a firm of using FX derivatives, I'm going to present one table. You can see more tables of this, robustness exercises and so on in the paper. This table asks the following question. What drives the decision of participating in the foreign currency derivatives market? It's a logic regression, takes a value of 1 if a firm is involved in trading the securities, and 0 if the firm is not involved. Okay? Let me highlight two coefficients here that have their proper stars next to them. The first is that firms are more likely to use derivatives if they have currency mismatches in their balance sheets. So they do play some role in fine-tuning the balance sheet mismatches that these firms may have. And second, and I think this is the most important result, because it suggests some causality between exchange rate risk and the decision to use derivatives, is that after a quarter, when a firm has posted losses deriving from currency exposure. We don't have to calculate anything here because there's a line in the balance sheet that says losses from currency exposure. It's very quite literary. After a firm has made losses, so take a 1 standard deviation of the loss, that increases the probability that the firm will use derivatives next quarter by about 9%. Interestingly, if the firm made money out of a currency exposure, they don't take derivatives. But if they get burned, they do. So I think this is nice sort of causal evidence suggesting that, once you liberalize the exchange rate and the central bank means business and will not intervene, firms do start using derivatives, but they are more likely to do so after they lost some money. Let me now go to the evolution of the exchange rate pass-through. As I was saying in the beginning, this is one of the main reasons why that has been advanced of why countries may decide to free float, essentially to limit or to achieve the fulfillment of the inflation target. So it's important to understand how the pass-through of inflation, of the exchange rate to domestic prices has evolved in time. Among many features, several authors have singled out the dependence of the exchange rate pass-through on the credibility of central banks. This is a large literature. I'm just citing some important papers for the Chilean experience. And indeed, we can see that Chile's institutions are in general strong. So the red line here shows where Chile ranks in a group of economies. This is the source of the World Bank governance indicators. So in the right-hand side, you can see that in general, regulatory quality of Chile has remained strong. But the left-hand side picture shows that central bank credibility, while in general ranking fairly high, it has been increasing in time, according to these indicators. Let me now show you, this would be probably the second graph that I would put if I had to choose two in the paper. This shows the evolution of the exchange rate pass-through. We do several exercises in the paper. Here I'm just going to talk about the one that comes from VAR evidence, in particular VAR that has an exogenous block for foreign variables. Okay? In the domestic block of this VAR, we use economic activity, interest rates, that's the monetary policy rate, the exchange rate, and inflation. And the exogenous block, we use industrial production in the US, inflation for the US, oil prices, food prices, and of course the federal fund rates. And these are all monthly frequency. The exchange rate pass-through is defined as the ratio of two objects, which are the cumulative impulse function between the inflation and the nominal exchange rate in response to an exogenous, as well, at least as identified from the model, an exogenous nominal exchange rate shock. There's nothing fancy here. This is just a Cholesky decomposition. What's interesting is that we separate the calculation of the exchange rate pass-through in roughly three 10-year period events. So the first one actually is the first 9 years before the introduction of the exchange rate flexibility. And as you can see, the exchange rate pass-through is rather large. So there's a bunch of lines. Let me explain this. This comes from a bootstrap methodology. I'm not going to go into the details. Let me just say that the red solid line gives the median estimation for this period, and the red lines, the red dots, show the actual estimation using the complete sample for that particular period. And as you can see, the pass-through went down from roughly 30% at a 1-year horizon to a current value of about 15% if you use the last 10 years. Okay? So essentially, 30% pass-through before the flexible exchange rate. Then between the flexible exchange rate and the global financial crisis, we went to a pass-through of about 20–25%, and now currently we have this close to 15%. That's the evidence that we show here. But let me just take the time to put forward a hypothesis. We know from different studies that the exchange rate pass-through depends on credibility. But when I look at these figures, we discussed this a lot with the co-authors. Chile started with a high degree of exchange rate pass-through. If you compare to other countries, it's a rather high degree of exchange rate pass-through. So how come credibility was attained? I think an important role is played by the actual design of the inflation target. So the inflation target in Chile is not about controlling inflation today or not even at a year's horizon, which actually you can see the figures for that in other work. They're quite volatile. But if you set the inflation target at a 2-year horizon, even with a high degree of exchange rate pass-through, that would tend to be low, as you can contain these short-term shocks at a 2-year horizon. So by providing this feasible target in the sense that it provides a reasonable output inflation trade-off, you add to that strong institutional independence of the bank, and this might be creating what we call a virtuous cycle between a feasible inflation target and the lowering of the exchange rate pass-through, which in turn makes achieving this target makes it a bit easier to achieve. Let me go to the second part of the talk, where we are going to document the macro-financial adjustment under free floating. And I'm going to start with this sort of experiment that we do by comparing the evolution of the Chilean economy, both in absolute terms and also in contrast to other countries, during the last two crises, the two important crises, the Asian and the global financial crisis. So here's the one-slide summary of what I'm going to show. Macroeconomic design was quite different at the start of the Asian crisis, as I'm sure you all well know. We had for starters, we had a crawling peg, which had to be defended, at least at the beginning. And we didn't have a fiscal rule. But at the outset of the global financial crisis, things were differently. We already had 10 years of freely floating exchange rate regime and also a cyclically adjusted fiscal balance rule well in place. Outcomes were generally better after the second crisis. GDP shows faster recovery. Private credit does significantly better than in the first episode, and as well as investment and the current account. And you put these things together, and perhaps the sufficient statistic of this is that the unemployment rate in Chile, it went up, of course, this was an important crisis, but it went down much faster after the global financial crisis than after the Asian crisis, where we had chronic unemployment for the next couple of years. The nominal exchange rate regime seems to be playing an important role. One key difference, as I mentioned earlier, is that at the outset of the Asian crisis, the central bank had to significantly raise the interest rate. The interest rate went up to 14%. This is in real terms. Back then when we conducted monetary policy in real terms. And this raising of the interest rate, of course, was it worsened the conditions in financial markets, in particular banks, and led to the classic credit crunch. At the global financial crisis, on the other hand, the exchange rate movement was allowed to float from the start. I'm going to show you that it did, and it played a stronger shock absorber role. Of course, many other factors may be playing their part here. We have the fiscal rule that I already mentioned. We have a very different evolution of copper prices, the role of China, complex incidents of shocks, and so on. So to partially address these concerns, I'm going to show you not only absolute evidence for Chile, but also in comparative terms with respect to other countries. Can you see this picture? I think the lines might be a little thin. There's a lot of graphs in the paper. Here I'm just going to focus on the comparison between these two episodes with regards to the external shocks that we face, policy responses, and outcomes. Okay? In terms of the external shocks, the upper figure, the upper left-hand side figure, shows the trading partners' evolution of GDP growth. And as you can see, in the global financial crisis, they went down significantly, much more than in the Asian crisis. Copper prices were actually much higher to begin with before the global financial crisis started. They tumbled, and then they recovered. In terms of policy responses, this is what I was highlighting before. In the Asian crisis, you have a hike in the interest rate and a fiscal balance that didn't change much. This is radically different in both dimensions at the start of the global financial crisis, where actually interest rates were lowered to almost 0% in less than 1 year after the crisis hit. Compare that to raising the interest rate by about 14%. That's a very different policy response. And this is in large part due to the fact that we didn't have to defend the exchange rate in the second episode. And in terms of outcomes, this is what I mentioned before. We have a faster recovery of unemployment, and a faster recovery of GDP. You can see the other variables in the paper. In this second exercise, we compare the adjustment of Chile across these two different episodes, but contrasting it with a large group of emerging market economies. This is important because there are a lot of confounding factors, so maybe the comparison can bring some light on the relative performance given the fact that Chile had a freely floating exchange rate regime and many of these countries don't. And what we see here is essentially that Chile's monetary and fiscal policy response are more accommodative in the global financial crisis, both in absolute and relative terms with respect to these countries. You can see, for instance, in the lower part of this figure, how the nominal exchange rate, in terms of this other group, was among the exchange rates that's most depreciated at the outset of the global financial crisis, but we were close to the median, actually below the median for the Asian crisis. And as a result, we had a relative better overperformance in the second episode with respect to these other countries. I'm running sort of short on time, so let me now present some evidence about a different type of adjustment, which I believe is a somewhat less appreciated trade-off, and has to do with how different asset prices respond to external shocks when you have a floating exchange rate regime vis-a-vis countries who don't have clean floats. Okay? Let me first spell out the argument. We know that financially integrated economies must deal with the effects of international financial cycles. This is a very interesting recent agenda. And a common tool to deal with these episodes is through FX interventions. For example, a country might be facing a capital inflow, and to dampen the effect of this on the appreciation of the currency, central banks may be tempted to intervene the currency. And I think the recent literature shows very clearly that they are effective in doing so, at least in the short term. But when they do that, a different trade-off appears, which is if a central bank contains the appreciation and contains the volatility, you are essentially improving the risk-return relation of foreign investors. You are making the posterior depreciation of the local currency milder, so that increases the return, and you're making it less volatile, so you reduce the risk. And both these channels work in incentivizing flows even more. And this is a point that has been very eloquently made by very prominent macroeconomists. Let me just put it this way. And I think a less appreciated trade-off emerges in this sense, essentially by mitigating the exchange rate fluctuations through the intervention of the currency. Central banks tend to rotate the volatility from the exchange rate into domestic asset prices. And why? Because they're encouraging even more inflows. And in this section, I'm going to show you evidence of how these relative volatilities look in Chile compared to other countries. And I'm going to use a sample of emerging and developed market economies. And let me just first quick pass through the data. I'm showing the volatility of the nominal exchange rate in the left-hand side figure, 10-year bond yields in the middle, and stock returns in the right-hand side of this figure. And the red line corresponds to the volatility of Chile in relation to these other countries in the group. Chile is roughly in the middle in terms of exchange rate volatility, but ranks quite low in terms of the volatility of 10-year bond yields. Also ranks relatively low in terms of stock return volatility. This is just a rough pass of the data. Now I'm going to present the results from a more clear event study methodology. In this event study, we consider two types of events, two types of shocks. The first are events that are quite important for fixed income markets, namely US monetary policy shocks. How are these shocks going to be defined? Every time the Fed meets, markets move, short-term interest rates move. That's going to be the definition of the monetary policy shock. This follows recent literature in this regard. The other shock that we're going to contemplate here is shocks to risk aversion, essentially episodes where the VIX jumps more than 2 standard deviations. And I'm running out of time, so let me just give you the broad picture here. First, we find that US monetary policy shocks have significant effects on long-term bond yields for both developed and emerging market economies. The effect is relatively small for Chile. It's actually non-significant in many of the specifications that we have. Risk sentiment shocks, on the other hand, have very large effects on stock markets, as you might expect. Actually, they are larger for advanced economies. They're probably more connected to the US. And emerging market bond yields rise. Advanced economy bond yields fall in these events, as you would expect, since there's a flight to safety. Interestingly, the impact on Chilean bonds is non-significant, so I guess we're halfway there. But more importantly to the point of the talk, these tables show that the relative volatility in Chile is much more biased towards the nominal exchange rate than to domestic asset prices. So I think this shows that, provides evidence that the exchange rate is playing an important role in absorbing these well-identified shocks. Let me just conclude. I think fear of floating can be overcome, and in this talk I hope to have conveyed some of the main ideas of how Chile has done so. I think Chile has adapted well to the key concerns that give rise to the fear of floating. In particular, corporate exposure to exchange rate risk has steadily declined, while markets, derivative markets have increased. And the deepening of financial markets surely plays an important role here. But I think the micro evidence that I mentioned also suggests a causal role of the exchange rate regime. Firms actively hedge using currency, they hedge their currency exposure after suffering losses in their balance sheets. And we also show that the exchange rate pass-through has declined monotonically, which is consistent with the enhanced credibility of the bank. Most importantly, exchange rate flexibility has served the economy well by helping the adjustment to different types of shocks. Let me just conclude with what can other countries learn from this experience? First, we believe that if central banks credibly commit to free floating, firms will have an incentive to reduce their exposure to exchange rates. This is, of course, helped by deeper capital markets, and in the case of Chile, one should mention the important role played by the development of pension savings in providing this scope for having a liquid hedging market. And second, a credible inflation target, especially a credible design of the inflation target, may be playing an important role in lowering the exchange rate pass-through, which is confirmed by Chile's experience over the past 3 decades. And importantly, to be credible, an inflation target should be feasible in the sense that it provides a reasonable output inflation trade-off. Thank you very much.
Now,